The stock market often appears chaotic, a whirlwind of numbers and unpredictable movements. Yet, underlying principles can help us understand its behavior. What if physics could offer a new lens? Newton's laws of motion, originally for physical objects, provide powerful metaphors for market dynamics. These aren't literal laws, but conceptual frameworks to gain perspective on market behavior. Newton's first law, inertia. An object in motion stays in motion unless acted upon by an unbalanced force. In the market, stock price trends, whether up or down, tend to continue due to momentum. Observe a prolonged uptrend, a bull market, where prices steadily climb. Conversely, a downtrend, or bear market, can also show persistent momentum. Investor psychology, herd mentality, and established narratives all contribute to this market inertia. But what constitutes an unbalanced force in the market? Unexpected economic data, like inflation reports or job numbers, can be a powerful force. Geopolitical events, such as conflicts or trade wars, also exert significant influence. Company-specific news, like earnings reports or product launches, can dramatically shift a stock's trajectory. Major policy changes by central banks, like interest rate hikes, are another key external force. Newton's second law, force, mass, and acceleration. Force equals mass times acceleration. In the market, the magnitude of a price change, or acceleration, is proportional to the significance of the event. A more impactful news event, like a major acquisition, exerts greater force on the stock price. Conversely, a minor product update would have less force and thus less impact. The mass in this analogy refers to a stock's size or liquidity. High-mass stocks, like large-cap blue-chip companies, are massive objects. They require truly significant events to move their prices substantially. Contrast this with low-mass stocks, like smaller, less liquid companies. Even minor news can cause rapid and dramatic price swings due to their lower mass. Newton's third law, action-reaction. For every action, there is an equal and opposite reaction. In markets, this explains corrections, pullbacks, or rebounds as reactions to previous movements. Consider a period of rapid, unsustainable growth, a speculative bubble. As the action, the inevitable correction or crash is the reaction as the market returns to fundamental valuations. Conversely, a sharp, irrational sell-off can be followed by a rebound. Value investors step in, creating an opposite reaction to the previous decline. These metaphorical laws highlight the importance of understanding market dynamics and external factors. While markets aren't physics labs, these analogies provide a useful lens for analysis. Patience, understanding, and a long-term perspective are key to navigating market movements. Rather than reacting impulsively to every force or acceleration, embrace the physics of finance for a clearer market view.